Welcome, everyone. My name is Kirsten Loita of Osage University Partners. We're going to affectionately call ourselves OUP throughout the webinar today. Today, we're bringing you, I believe, for the sixth time, I think we've been doing this since 2017, our annual discussion on startup financing trends to understand current market behaviors among startups. So welcome to this. We do view these webinars as a great opportunity for our partner institutions, tech transfer offices, and associated entrepreneurial activities to ask questions in real time that they may have on startup financing trends for particular industry sectors. So we're going to encourage people to send in their questions today, and we'll answer them if we can. If not, we'll follow up afterwards on those. And to answer a lot of those questions, we have two terrific panelists with us here today. Let's go to the next slide. And I'm going to have them introduce themselves now. So let's start out with Manny.
Hi, everybody. It's nice to have a chance to speak to you all today about what's been happening in the past year. I'm Manny Stockman. I'm a principal on the tech team. I've been in here now for about 6 years, so looking forward to your questions.
Terrific. Mitra.
Hi, everyone. Miri here. My background is PhD in neuroscience from Yale, and then moved into Biopharma strategy consulting at LEK in their New York City office. A few years there, and then shifted over into venture capital, initially at a firm called Connecticut Innovations, and then joined the OUP Life Sciences team last year.
Great. Thank you both, and thank you both in advance for sharing your experience today. We're going to move on to the next slide, which is just an overview of OUP. For those of you who don't know us well or don't know us at all yet, we do want to just provide this brief overview of who we are. We're a venture capital fund that invests in startups out of academic research institutions. We invest anywhere from seed rounds all the way to pre-IPO rounds, and we invest in all sectors that the academic research institutions are inventing in and creating these startups in. So life science, software, advanced materials, semiconductors, clean energy, and more. And we invest often through something called participation rights that the universities may have in their license agreements. And we do actually share a portion of our profits with the academic institutions we're partnered with and through those investments that we make in their startup companies. We're currently investing out of our third fund, and across our three funds, we've raised about $600 million. We've invested in over 125 spin-outs from academic research institutions, many of which have IPO'd or been successfully acquired. So it's been a really terrific venue to be able to work with all these academic research institutions. And these webinars are part of the benefits for our academic research institutions. So we'll move on to the next slide. So today's topics that we'll review are life science trends in financing, tech trends also in financings for startups, then IPO trends. People probably have a lot of questions on that IPO market and what's been happening with it. And then Manny will go into a short diatribe, maybe that's not quite the right word, but a short set on the rise of cleantech, or the re-rise really of cleantech and the interest in that area. And then we'll do a wrap-up summary. So moving on to the next slide, just to remind people, you can find this presentation. Obviously, if you're already viewing this later on through our YouTube channel, but also for our academic research institutions, we have our partner portal. And both researchers at the academic research institutions as well as the tech transfer officers have access to this portal, and you will find this on there. On the links that we have shown here. There's also going to be supplemental slides that will be available through the portal that you can find there as well. So next slide. Actually, before Mitra, you get into this, I just want to remind people that we're not going to have a dedicated Q&A period for this webinar. So we encourage people to ask questions throughout the webinar. Please use the Q&A box for your questions rather than the chat box. I can manage the questions a lot more easily through the Q&A box. So please put them there, and then I'll bring them up to our presenters as we go through the different sections. And we do appreciate all of you who already provided your questions beforehand. We will be getting to those as well. So I will pass this over to Mitra now.
Great, thanks, Kirsten. So we generally start with an overview of the whole life science sector. And what you see here is a combination of external and internal data. And many of the slides will have data pulled from Silicon Valley Bank's annual healthcare investments and exits report, because it's really just an excellent resource for trends analysis within the life sciences space. To orient you, on the top, you can see a bar graph depicting a summary of life sciences investment dollars by quarter from Q1 2019 through Q4 2021. This is further broken down by sectors, including biopharma in green, health tech in blue, diagnostics and tools in purple, and devices in orange. So the gray line on the top represents the total number of deals over those same quarters. And I really like this graph because it's broken down by quarters, and you can see not only yearly trends, but also observe intra-year dynamics that would have been obscured at the year view alone. As a whole, 2021 was strong in terms of overall financings and financing dollars, with Q1 2021 a quarterly record. We'll go into more detail in subsequent slides about drivers of these trends by segment. But here we can see by mid-2021, we're already starting to see a downward trend in capital invested, particularly in biopharma. And this is driven by poor IPO performances in the first half of 2021, with the ripple effect here being that more crossover funded companies remained private. This discouraged crossover investors from investing in additional private pre-IPO mezzanine rounds, which reduced the biopharma investment numbers overall. The bottom table shows the investment dollars flowing into the US and EU from 2019 through 2021 by life sciences subsegments. And here you can see a similar trend in the EU as well as the US, with growth across all life science segments from 2019 to 2021. Next slide, please. So now we're going to dig a bit more into different areas of the healthcare sector, starting with therapeutics. So the data on this slide focuses on university spinouts specifically and is based on our internal data here at OUP as well as PitchBook. So we have an internal database of over 15,000 university startups that include active, dead, and acquired opportunities. So we've been tracking these inputs over the existence of OUP, and a good chunk of the data comes directly from our university partners. So I would like to take a moment to thank our partners for providing the information that is really at the core of our analytics here. So the rest of the data comes from sources such as our network, publicly available sources, as well as direct follow-up with companies. Here, we pulled all startups from our database that are linked to a university and categorized them based on area or sector that they're in, and then pulled the financing information from PitchBook on them. So companies on this slide are all therapeutics-focused startups that are linked to a university. Some of the upward growth that you see in the graph is simply from us adding more universities to our network and creating a more robust data set to work with. However, in the last few years, these affiliations have become pretty stable with regards to the number of universities in our network. So you can see a real increase in the amount of capital flowing into university-based startups. If we plot out the capital invested in university therapeutics over the last 11 years, what we see is that there's an 8.5 times increase in capital flowing to these opportunities, with strong growth really seen over the last 4 years and continuing through 2021. With deal count in dark blue that you have mapped over this graph, you can see that there's a trend towards larger rounds for these spinouts. And this is really driven by more mature companies raising larger rounds to support clinical stage development, as well as larger, earlier stage rounds, which encompasses seed and Series A. Next slide, please. Okay, so if we look at trends in biopharma, on the left, we see the number of deals and capital flowing into biopharma by indication, which are broken down into platform, oncology, neuro, autoimmune, autoinfectives, and orphan and rare diseases. So overall, there were a record number of deals and capital being invested in biopharma in 2021, with the exception of rare and orphan disease segments. Across the rest, most indications continued their upward trends. On the right, we look at this data specifically for seed and Series A investments over the last 3 years. And you can see this broken down by indication once again. And overall, the seed and Series A dollars were up significantly. And not shown here, but cited by the SVB report, is that seed deal size increased substantially in 2021. And this really blurred the line between traditional seed and Series A's, with recent seed deals hitting 10 to 20 million per deal. And these were often backed by institutional investors, not just angels. So in terms of platform companies, in terms of what's happening in this sector, platform companies led the seed and Series A biopharma for the second year in a row since 2019. And we saw almost a 7x increase in neuro dollars as well. Anti-infectives also saw an increase, and this is really driven over increased investments over the last year. And by contrast, the orphan and rare disease segment dropped 57% as compared to 2019 funding amounts. Of note, deals in the 30 million plus range saw the largest jump, in pre-money valuations. And this was up 52% from a median of 27 million in 2020 to 41 million in 2021. However, once again, per the SVB analysis, there was a trend towards cooling down in Q4 as crossover activity has been slowing. Next slide, please. So we've received questions during past webinars about the geographic mapping of investments, and I think Silicon Valley Bank probably heard this question. So very happy that I'm able to share this figure depicting US biopharma investments by region. And we'll have these for other life science sectors as well, and they follow the same schemes as this one, where blue denotes the Northeast, purple is the West, yellow Midwest, orange is Southeast, green Southwest, and let's call this tangerine for Rocky Mountains. So what we observe here is what we might expect, with biotech hubs in the Northeast and West Coast dominating investment activity. However, places such as Seattle and Philly, where OUP is headquartered, are also seeing strong levels of investment activity. One last thing to note is a 2021 uptick in activity in the Midwest, where companies such as Jaguar Gene Therapy is based. And we have noticed a mini hub of biotech innovation really maturing in the Chicago area. Next slide, please. So we're going to shift gears now to look at the device sector. We pulled device startups from our university database and looked at the financing activity seen over the last few years in the university device sector. Notice this chart is different from the therapeutics graph. There's less activity, fewer deals, and less dollars overall. However, the sector has seen increased capital invested as compared to 2018 and 2019, with a new record set in 2021 beating the previous record in 2018. There was also a modest increase in average deal size observed in the sector, increasing to 8.1 million per deal from 7.6 million. Next slide, please. So when you look at the sector as a whole, there was a massive increase in 2021, pushing it far ahead of 2020 investments and almost doubling the investment pace of 2018 and 19. The device investment peaked at $3 billion in Q2 of 2021 and then declined slightly in Q3 and Q4 with the device investment surge led by larger, later stage rounds. Technology-enabled services such as non-invasive monitoring and imaging continue to attract the majority of investment in devices overall. And if we look at seed and Series A dollars and deals, early device dollars spiked to over $1 billion for the first time ever, and this was similarly led by tech-enabled services. So you're probably wondering about COVID-19's influence. So COVID-19 and the pandemic continue to influence investment in the space, as continued increasing dollars or investments in non-invasive monitoring, which it was up 92% in 2021, was a major focus. The need to monitor patients outside of the hospital setting has become critical during the pandemic, ushering in more investment in non-invasive monitoring as well as imaging. So one additional item to note is that half of the highest valued private device companies have not yet reached the revenue stage. For these early stage companies, access to public markets may be impacted by the poor IPO performance that we experienced in 2021. Also, based on the broad public market trends, crossovers will likely be less active in late stage device deals in 2022. Venture investors, however, will likely remain interested given the amount of capital that they've raised, and although they will probably be more valuation sensitive. Next slide, please. So this slide covers who's investing in the space. And here we can notice a lack of traditional venture life science venture funds, with the exception of maybe Perceptive and RA Capital, as well as corporate J&J that has an expansive mandate across healthcare due to many franchises under its umbrella. However, there are more tech-focused institutional funds such as Shanghai Capital that have a strong presence in the space. And from past SVP reports, we've seen that the space consistently garners interest from corporate funds such as Mayo Clinic. You can also see firm interest based on device segments across imaging, non-invasive monitoring, as well as neurology. Next slide, please. Here we see the US devices investment by region. And again, we see device hubs in the Northeast and West as expected that are dominating investment activity. However, places such as Seattle and Houston are also seeing strong levels of investment activity as well. Additionally, we can see overall trends towards greater device investment across the whole US in 2021 that has spread beyond the Northeast and West Coast. Next slide, please. Now we'll look more closely at the diagnostic space. For university diagnostic spinouts, we saw a similar trend as in 2020, with over $2 billion of capital invested. Similar to other life science sectors, we're also seeing the trend of average deal sizes increasing, and you can see that depicted here. Next slide, please. So SVP report also indicates, or it also groups diagnostics and research tools together so that when we talk about them, we're talking about both of these in the following slides. So the total diagnostics and tools investment hit a record in 2021, surpassing the capital invested in devices by $4 billion. However, while early stage investments in diagnostics and tools was up in 2021, the dollars continue to lag the other three sectors for the second year in a row. Surprisingly, seed and Series A deal counts was up significantly, doubling the pace of these in the last 2 years. The pandemic continued to drive consumer demand for home testing, and as a result, diagnostic test activity spiked in 2021. And it's not shown here, but reported also by SVB, was that this diagnostic test activity was focused in the areas of platform tech, oncology, anti-infectives, and urology, as well as gynecology. For the R&D tool subsector, there was a significant early stage financing focus, and this was really centered around computational companies such as Beacon Signals, as well as synthetic biology companies such as Slingshot. Diagnostic analytics, which really leverages AI and ML to help clinicians make better decisions, experienced an increase in deal activity in 2021. In this area, there was a very strong focus in oncology. Of note, public market access for the segment, in terms of public market access for the segment, although the IPO performance was down, there were many positive examples of highly valued private companies that went public. One such example is Oxford Nanopore, which is an R&D tools company that's focused on sequencing as well as molecular analysis. it had the third highest valued financing in 2021. So the company originally went public in Q3 and was trading at more than 2x its last private valuation at the end of 2021. So this is really a success story. Next slide, please. With regards to investors that are active in the diagnostics and tool space, you can see it's a bit of a mix. You can see a lot more traditional tech investors such as 8VC, as well as those who are more focused on life sciences such as RA Capital and Perceptive. This is really a diverse group of investors in the space that really is at the intersection of tech and life sciences. And at OUP, we often bring together the tech and life sciences sides of the house together to look at these opportunities. Next slide, please. So here again, we see diagnostics and tools hubs in the Northeast and West dominating investment activity. However, cities in these regions such as Seattle and Baltimore are also seeing strong levels of investment activity in addition to the traditional Bay Area, Boston-based focus. Of note, the Southeast has been gaining traction as a region for diagnostics and tool investment activity, with Durham acting as a local hub for innovation in the space. Next slide, please. So the rapid pace of investment coupled with the increasingly quick turnaround from first venture to exit over the last 5 years has really propelled firms to deploy capital faster than ever. Given the frothy markets, many firms have increased their fund sizes. All this momentum has turned 2021 into the largest healthcare fundraising year ever. VC funds raised from LPs raised over close to $30 billion this year, which is close to 10x more than 10 years ago. Flagship, Arch, and OrbiMed are all closed $1 billion plus healthcare only focused funds in 2021. So the dry powder overhang embedded in funds means that deployment of capital into companies in the space will be quite strong over the next several years. So this is my last slide for the life sciences section, and I'll turn it over to my colleague Manny to walk you through the tech trends. Actually,
we're gonna jump into a few questions first before we go to Manny. Although Manny's going to answer some of these as well, Mitra.
Awesome.
And one of the questions that came in actually is directly related, I think, to the slide that you presented, which was, are you seeing new investors coming into account for the increase in capital, or is it primarily existing investors deploying more capital?
It's a little bit of both. So we have the traditional, like for example, in biopharma, we have the traditional, therapeutics focused funds writing larger checks, but we also saw an increase in generalist firms and funds coming in and writing checks as well.
And Manny, same question, I think, for the tech side.
Yeah, I think, observationally, there's been a number of tech funds that are going into life science, and they're taking a different tack, and some of them are starting to co-invest with classic life science investors, and so we'll see how that plays out. And then overall in the tech community, there's been a number of monster funds, like most notably some of the Sand Hill Road funds have just raised bigger and bigger dollars. Tiger Global and Co2 and others have started to raise really large funds and move into venture. But no doubt, a lot of the new investments are also coming from brand new seed funds that used to be angel groups, and we're seeing a lot of activity across the board, and you'll see it in some of the numbers.
Great, thanks. So another question, and I think actually we can't answer this one specifically right now, but we're going to look into the numbers more. But I thought actually maybe you could answer it just kind of by feel, and actually maybe you do know some of this, Mitra, excuse me. Do we have information on by therapeutic, basically by the financings that are happening, but happening by modality, by basically a breakdown between small molecules, biologics, cell and gene therapy, and what are the trends across those?
Yeah, great question. So modality cut, conventional small molecules have grown slowly. The biggest growth drivers are really cell and gene therapy growing, I believe, at about 14% annually. And I think we have about 1,000 preclinical and clinical programs. And so there's a lot of money supporting development in the space. And although the space is crowded and competitive, these are enormously compelling modalities. So they're ones that a lot of funds are looking very closely at. One thing that I will say, though, is there have been setbacks in the space, whether it's, if we're looking at genetic medicines as a whole, there's been some durability questions with AAV, and ASOs have been stumbling in ALS. We saw that in Huntington's as well. So just some things to keep in mind.
Mm-hmm. And then going along with that is what about drug discovery and startups? How well are startups that are doing true drug discovery being financed?
Sorry, can you rephrase that?
Well, so the question was, are investors financing startups that are doing real drug discovery, perhaps not already starting from a certain point that they've, perhaps some kind of platform in this area on drug discovery versus, they're coming in, they already have the small molecule identified, et cetera?
Oh, absolutely. And I think Manny can speak to this as well, because this is really at the the convergence of tech. Of tech and biotech, where you're taking the knowledge of the medicinal and other types of chemists, right? And biologists, and pairing that with computational biologist knowledge, and really creating a more efficient way to discover new structures and new targets.
All right, we had another question on changes. Are we seeing any changes in pre-money valuations or other investment terms? And actually, our analyst did a little bit of research on this while we were on the call. Manny, I don't know if you want to answer it, if I should read off what our analyst brought in on that.
I think the Bill's comment was more on the Therapeutics his
valuation. Yeah.
Information on Slack, which was, on Therapeutics university spinouts, the median pre-money valuations double from 2020 from 26 million to 45 million. The mean is kind of always based on the outliers. So that one stayed relatively flat, as I understand it, but that's the medians are what we pay attention to. And that's a lot. And on the tech side, it's undoubtedly, these valuations are stratospheric in the past year.
Yeah.
Major growth.
Yeah. All right. I have one more question, and then we'll move on to the tech trends. What is the impact of the current market turmoil and inflation, et cetera, having? What are the impacts it's having on increasing rates on VC investment?
Mitra, I think this is more relevant for the public markets on the biotech side.
Yeah, probably. And we're going to talk about some of the impacts of the IPOs and stuff soon, but just kind of general comments on the impacts on the turmoils in the markets and the inflation.
I can't really speak to inflation on what it's doing to biotech. All I know is just the valuations have been impacted. And so people are less interested or more risk adverse when it comes to crossing over. In terms of private, money, as I mentioned, there's been huge funds being raised. So it really isn't impacting the private setting at this point.
Yeah.
So Manny, I'll just let you answer anything.
And then on the, for software companies, which are oftentimes on the private side, startups are being valued or given some premium multiple on revenue above what the public market enterprise software companies are receiving, which, the past couple of years has been north of 30 or 40x for public market fast moving startup companies. Now there's a depression in that, so it's around 15 or 20x. And so some of the startups are starting to, the ones that are judged on revenue are starting to sense that in the space that most of our universities operate in, and I imagine you all pay attention to, which is very early seed stage. I don't think the public markets are having an effect on early stage, seed stage company valuation yet, but they will. It's a slow process that the private markets respond to over time.
Okay. Great. Thank you both. We can move on, Manny, then to the tech trends.
Great. So next slide, let's jump to the next one. So I look forward to this every year because it gives us a chance to kind of step back and see what happened. And 2021 was frenetic, and there was a tremendous amount of deal activity. And for a fund like ours, where we do really love taking every opportunity seriously that we see from the universities. We have to, be active, but also, pay attention to fundamentals and understand what's driving these companies to success. And overall, it's 2021 was out of this world in terms of the amount of venture dollars that were deployed. So if you look on the top right, this is just overall venture activity. This is not a university specific profile. The $285 million that went into tech companies last year is roughly 2x 2020, and 2020 was pretty surprising also. And this amount does not represent a COVID response. So this is just an increasing response to the growth of the number of venture firms that are out there and just how much capital is available on the market. What's surprising, if you actually go back to 2000, the venture dollars in 2000 were actually around $120 billion, which was surprising when you actually compare that to 2020. It's amazing that 20 years ago, the scale was actually similar. It crashed in 2020, and it just slowly crept back up to the north of $100 billion. But 2021 was just really surprising for a lot of people in the industry to see. We felt it. There was deals happening consistently and very quickly, and a lot of the as you'll see in some of the data, a lot of the deals were very large. So on the bottom right, we look at the kind of breakdown of how the size of the rounds has changed over time. And clearly in 2021, there's almost a 2x increase in the investment rounds that were north of $25 million. And so that oftentimes is an increase in Series B, Series C stage companies investment activity, but we've also seen an increase in the size of Series A and seed rounds as well. And so this has just been a move towards deploying more capital in your startups. And also that usually is matched with bigger ideas too. So these companies, to get the types of dollars that are interesting to venture firms now that they have more capital to deploy, also means you have to sell a bigger vision. So the deal sizes are growing, the investment dollars are growing, and I think it's going to continue that way for the next year or so, at least as far as we can tell. There's still a lot of dry powder out there. Why don't we jump to the next slide? When we presented last year, there was an interesting trend that some people caught on to, which was just, it felt like the deals that matter for university startups, their earliest days, their first dollars were slowing. So the angel rounds were, a little more difficult to come by, and seed stage was, the average check size was growing and the number of deals were not. But I think in 2021, we saw an increase in the angel activity. So it was the first time it's grown since 2015, which is great. I think a lot of the university ecosystem benefits from a strong angel base. And while those check sizes are smaller, they're really important. And I think there's a lot of groups out there that are getting to be very sophisticated in how they, angel groups are getting sophisticated in how they access university startups and startups overall. This is something I think, as the world moves more towards investing in deeper science and technology startups, angel funds are also going to have to invest in that space. And I think the incubations and efforts we see on university campuses really blend nicely with some of the angel groups that are surrounding campuses. And so we've been enjoying getting to work with some of those groups. The capital invested in seed stage companies also, really grew almost 50%. And I think, there's two aspects of this. There are more seed funds out there, but OUP included, we're seeing the need to move earlier, and many funds are as well. The reasons are because you have two dynamics at play. One is valuations are growing, and the way to create great returns is generally to invest before the valuations are so high. And so funds are figuring out ways to move earlier. And also you have this upward, tier of investors in the very late stage areas, which are moving earlier and earlier. So you have, I'm sure a lot of you have read about this. You have groups like Tiger and Cotu deploying $200 million in Series C, Series D rounds, but they're also starting to invest in Series A rounds. And so it's just making it a competitive environment, which is really startup friendly. So I think, the kind of themes for the financing trends on the tech domain, mega deals, and then, startups are really in the catbird seat right now. I'd say deals are happening very quickly, and startups are able to get meetings with many investors and move towards term sheets at a very rapid pace. Not always a good thing. So startups that really need to work closely with an investor should really be thinking about, it's not just about getting the best term sheet at the highest valuation, but who do you want to work with, and really focus on more than just the numbers of the deal. So we can go to the next slide. And so when you break this down by sector, this is still broad venture in general, not university specific. I love that stuff. We'll get to it in a second. This is just looking at the overall venture dollars deployed into various sectors. And it was, a banner year across all sectors. They all nearly doubled. Software continues to be the primary sector in which venture deploys its capital. So roughly around $175 billion into software startups last year, which was higher than the total amount of venture dollars of any year for the past 10 or 15 years. And so software continues to, unsurprisingly, be a major area for investment, somewhat driven by the success that enterprise tech companies created in 2020, when they were able to help everyone consistently work through COVID and show that the gains you have in enterprise software have been really significant. And, but not to be outdone, physical sciences was significant in 2021. I mean, $65 billion into, I think it was maybe hard, you want to call it hard tech. It's kind of at this broad scale of general venture activity. It includes many categories, but physical sciences, I think of as semiconductors, climate tech, robotics, materials. At $65 billion, that's roughly what 2x biotech was last year. And so that's a very interesting data point that for the first time, we're observing this massive influx into that domain. And I think it's a sign of some of the continued overall, venture interest in pulling away from a little bit of the consumer software investments and, app technology into more focused big tech areas. The deal size, as I mentioned, has been growing, and that's on the bottom left, where you can see the average deal size doubling in some categories. In the later stage rounds, the means you would find are much, much higher than the medians. And that's because there are several outlier investments that have just really kind of been surprising on the market. And we'll look at a couple of those in a few slides. I think that with increasing deal size, since a lot of tech companies focus on dilution, whether you're raising 20 or 80, you think of things as a baseline, maybe you get 10 or 30% dilution. Valuations have also grown. And the other figure for valuations that matters is obviously just how much investor interest is there. And there's a lot of investor interest into all of these startups. So next slide. So this is what I love looking at. This is, I think Mitra hit on this. We have a really intriguing set of data of university spinouts. I think it's a very unique data set that we only have because of the contributions you all have provided us into the database of, knowing, I think it's around 10,000 university startups that have existed all time. And we're able to look back at the historical fundraising profiles for these startups and evaluate it across sectors and stages. And so if any of you are interested in us diving deeper into these data sets, do let us know. But this is a snapshot of the venture investment into tech spinouts across the last several years. And 2021 was over double. And so, there was twice as much investment in university tech startups in 2021. And there was 1,000 financings. Nominally, the number of financings decreased by about 10%. So the average deal size did grow around 20% from 120%. And that is, a nature of, I think, some of the university tech spinouts are really kind of pushing forward very large ideas that take a lot of capital to succeed, and the investor interest is there to do so. And so this has been a really exciting past year for our partners at our universities, as well as ourselves, because we're seeing a lot of our companies really start to scale now that they have the capital to do so. I think some of the interesting aspects of what happened in 2020, 2021 were because of the SPAC boom that happened in 2020, which, without a doubt will not exist in the same modality it has in the past year or so, but it has shown that there is public market interest in these deep tech categories that I think also is starting to trickle down into venture investment in the space. So next slide. When you look at the breakdown of the tech sectors that are attracting the most funding, we all know that across general venture, software is the primary category. But this is breaking down investments in university startups by the sectors that we track. And we have much more fine-grained data, but I do like to break it down into physical sciences, software, healthcare IT, and kind of a blanket all of other, which is just not a very descriptive thing, but it can kind of, like sometimes we see oil and gas companies in other areas. But the most interesting part of the university domain is, in the past year has been just how much capital has gone into physical sciences companies. So one thing we know on the life sciences side is that a tremendous number of the greatest biotech startups do come out of universities. I think we kind of hold in the back of our mind something like 50% of all therapeutics venture dollars go into university therapeutics companies. Similarly, 20% of all venture dollars in physical sciences go into university physical sciences companies. And so that's a really interesting number. It's significant because the overall denominator of venture dollars is so large in the tech world that 20% is still a significant number. You contrast this with software, which is 5% of the software dollars that go into university startups. It's obviously much smaller. It makes the pond a little more difficult to swim in, but there's still a tremendous amount of venture investment in the category. So $9 billion went into university startups in 2021 in the software domain. There's also a number of great healthcare IT companies in the university startup domain that have been able to capture some activity in that space. Around 10% of the overall venture investment in healthcare IT startups went into university startups. And so I think the big question for 2022 is, will this continue? Will the overall increase in tech investment continue? Will we see more, more of the ball moving into our court of university startups? Is something that's hard to predict, but I think given what we'll talk about in a little bit with climate tech and how big of a portion it was of the venture activity for 2021, I think we'll continue to see 2022. Next slide. So, this is an interesting, just kind of, anecdotal chart of what's creating this dramatic increase in venture activity. The short is that, there are a few very large mega startups coming out of universities, which have accounted for a significant portion of the venture activity. So nearly a third of the university spinouts nearly a third of university spinout capital was raised from just about 9 companies. So, that's obviously a number that everyone should hold in mind. But what's exciting is that some of these startups are able to capture that much capital because the ideas are just that big. And this is why we love swimming in this pond, is because we really have an opportunity to invest in, world-changing companies. So, on the left, you have Commonwealth Fusion, who is going after an incredibly ambitious project to create, finally attack fusion on the private side. These are, typically, publicly funded efforts. And there's a new world of investing in this this world of private fusion. And also you have important things like Sila, which may become one of the most important battery technologies in the world, continuing to eke away at some of the risks involved in that commercialization effort. And they're starting to get their first design wins, and hopefully we'll see them in EVs in the next couple of years. To one of our portfolio companies, Sci5, which really started as a very kind of academic semiconductor design concept that is now scaled to take on some of the biggest the biggest juggernaut in the semiconductor world, ARM. And they're really having the whole world align behind this concept of RISC-V that started as a teaching tool. And so these are some of the great ideas we see out of universities. And in the software space, there are also some that are just as large. So Databricks will undoubtedly be successful. And they have become this ubiquitous tool in all the things that are important for data infrastructure. And so one of the other ones I love looking at is Second Spectrum, because if you're a sports fan, they're the ones that put the dots in ESPN news reports on NBA shooting locations. And so they've really been able to scale that company and do amazing things. To some of the other really interesting healthcare IT companies like Ginger and Spring Health, where I see a common trend is the companies that are actually able to raise a lot of capital in that space. It's actually not historically been an efficient path to create healthcare IT companies that sell tools to doctors. They really are going after healthcare IT solutions that are driving, creating solutions for employers or individuals. And so Ginger and Spring Health are two that really do that well, where they've come up with effectively telehealth solutions for employers in the mental health space. So there are some common themes we're starting to see over the past 5 or 6 years of increased activity in healthcare IT. Why don't we go to the next slide? Yeah, this was the slide we do every year for the audience, just to let you know of the investors that are really active in the university spin-out space. So these are some of the most active investors in the startups in our database. And so unsurprisingly, the early stage VC groups that we work with tend to be the same every year, where it's NEA and GV and Andreessen, all the names that we think of are very active in the space. These are the most numerous investors in each category. But we're also starting to see on the left, new funds that aren't, new groups that are not in this list here that are starting to really increase the rate of university startups that they work with. So you have places like Y Combinator that are starting to really focus on deep tech and life science, bring in startups into that fold, as well as new kind of very clean tech focused ones like Activate, starting to be really helpful to start companies in the university spin-out domain. And then because physical science is such a large portion of the deals that we see, but not necessarily the most numerous, we also wanted to highlight the non-software investors. We often talk to universities and they say, well, we know all the software funds. It's very hard to find a good match at them because they'll do university deals every so often. In the non-software space, there are very active investors who like deep tech, and these are the ones that have most often popped up. So, Lower Carbon has just, come on the map in the past 3 years and just been incredibly active in the climate tech space. I suggest, anyone that sees a lot of, growth in that space for them, do find a way to connect with Lower Carbon because they're very interested in very early opportunities. And the engine has done a great job in the Boston ecosystem as well of capturing a lot of the exciting startups in that area. And they're also, I think, starting to increase their geographic footprint. So, for any of these investment groups, if you're looking to get connected, let us know. And we're happy to, help you get introduced because we think all of our universities need as many good venture connections as possible to create better product market fit ideas for the early stage startups. I think let's maybe go to the next slide. Yeah, I think we can pause there and see if there's any questions we want to hit.
Yeah, there is one question specifically for you, Manny. And in your mind, is the 2x money flow in 2021 over previous years aligning with larger market sizes and opportunities? And basically, are they trying to address bigger problems and opportunities?
I think so. I mean, I think some of it is the startups are scaling. And they're showing that they've been able to convert some of their technology into real product market fit at a very high revenue rate. And so some of these monster investments have driven 2021. But then there's a whole category of climate tech, which has created another set, which is going after very big problems. I think that's probably the category where I'd say it's clear that the bite of the apple has just gotten to be bigger. And in a great way, entrepreneurs and academics are starting to realize that, no, let's not just sell a raw material. Let's, build a plant that captures carbon. And, these are the types of things that also capture venture attention. And so I think the bite of the apples are getting bigger too.
Great. That was the only tech-specific question we had right now. We've got some other more general questions, but we're going to hold off on those till we get through the next two sections. So.
Great.
Mitra.
Great. We can move to the next slide. Awesome. Okay. So there were a lot of records in 2021. If you've noticed a pattern in this presentation, well, there were also a record number of IPOs in 2021 with a number of university spinouts, including some of OUP's portfolio companies, such as Sana, Dice, and Graphite, participating in that momentum and using the IPO vehicle to access money. And quoting some data from Bruce Booth's Venture Year in Review regarding the speed of the venture cycle, in 2013, the typical IPO candidate was 10 years old from founding to IPO. And today that number is 4. So really an acceleration of scaling young companies into the public market for them to access capital for portfolio building. And earlier stage companies are accessing this type of capital, with approximately 80% of the companies that went public over the last 2 years not having human proof of concept data. So that means that they're either preclinical or phase 1 at the time of IPO. All right, next slide, please. So the last 2 years have comprised the most prolific IPO market of all time. And during this period, it wasn't uncommon to hear terms such as oversubscribed, upsized, above the range. And although IPO median pre-money valuations hit a record high in 2020 at about 500 million, they dropped in first half of 2021, making a downward trend in the subsequent quarters. Additionally, aftermarket performance has not been so hot, and that's what has really impacted the overall investor sentiment starting in second half of 2021. So by the numbers, for the 2021 vintage, the average post-IPO performance was negative 21%, with only 3 companies trading above 100%. By comparison, the average IPO performance for the 2020 class was over 100% at the end of 2020. So since 2018, early stage IPOs, so these are preclinical and phase 1, appear to have better post-IPO performance than later stage deals. However, the large difference between average and median performance for these early stage IPOs indicates that there are a few outliers that are, or big winners that are artificially driving this performance up. Regarding concentration of IPO activity, oncology-focused deals continue to dominate the number of IPOs, accounting for nearly half of the 2021 IPOs. So that wraps up IPO Trends section. I'll turn it back over to Manny to walk us through the Cleantech section if there are not any questions that we can address here.
Not yet.
Awesome.
So so this is a discussion of what's been happening in climate tech, and it's actually been interesting. Every so often I think of it as climate tech 2.0, but I've every so often heard climate tech 3.0, and I'm still trying to figure out what the 1.0 was in that case. I'll have to go ask Mark to see if he knows. So climate tech is clearly having a moment right now, and it's based on, I think, a couple things that have been pretty interesting in the economy. And 2 things I think are happening. SPACs have described, like I've already described how SPACs have shown that there may be more public market interest in going after these big bets. The other is a lot of the major Fortune 500 companies are starting to announce significant net zero goals that do seem as if they're sticking to this plan of investing in being clean. And what that has created is an influx of venture response into the category and some aspects of responsibility for climate and what's going on in the world, and interest in going after some really big ideas. And so let's jump to this next section. So as you can see, this has been a significant increase. And what you'll find if you click through the next one is that this is actually what happened in the first climate tech boom. So over the years, there was a significant increase in what was occurring in the mid-2000s and 2008. And we're sensing this return of climate tech. And why don't you jump to one slide forward? So 2008 was around $5 billion, which is a significant amount of capital for that time period, when overall these were kind of still in the doldrums after the crash of 2000, where climate tech was really capturing the attention of a lot of investors and created some interesting opportunities. Now, if you go to the next iteration on this slide, you'll see what's happening now, which is there was climate tech purgatory for several years, 2009 to 2017. And last year was unbelievable what was happening. So capital invested into climate tech was around $25 billion. And that is a shocking amount of capital. And I think the aspects of this which are really intriguing to us is just how much is coming from the university space. And so I think we get into that in the next slide. Can we go to the next slide here? So, where is this momentum and inertia coming from in the clean tech investment category? And while universities were a fraction of the broader activity, it was a tripling in growth of year-over-year investment in university climate tech companies that we track very closely. We know about all these companies, whether it's battery technologies, different approaches to carbon offsets or carbon sequestration. And so the amount of investment increased over 300% for university startups in the climate tech space versus just around 100 across the overall industry. And the average deal size grew also. There was a tremendous amount of interest from the venture community, classic standard funds and brand new funds that have raised several $100 million funds to go after some of the biggest challenges in the space. And in both the university category and the broader clean tech category, the most active investors are ones that many of you all may know. I mean, Breakthrough Energy Ventures has created north of $1 billion fund to invest in these activities, and they have a very long funding horizon, as well as Lower Carbon Capital, which was started by Chris Sacca, who is a fantastic investor in the consumer space at Lower Case Capital, I think, who has kind of made it his life's mission, his team's life mission, him and his team's life mission is to solve some of these big climate challenges. And so they are really interested in looking in this category. They're very interested in disruptive ideas, and they seem to be very patient. The other aspect of it is they seem to be able to amass other investors that are non-traditional investors that have, will bring together something like $20 to $100 million for some of these startups. And the pace of the deal making has been very quick. We've seen startups raise modest, Series A rounds of $20 million. 8 months later, raise $100 million on top of that recent one without much technical progress. And I think these are some of the challenges in the space that I think we will see how they play out. The valuations have grown. The valuations don't match what historically we'd think of as the right risk reward profile. But if some of the categories that they're going after are able to scale and generate revenue that we would hope they would, given the magnitude of what they're trying to solve, then these companies can become multi-billion-dollar startups, and that's the goal here. The biggest thing that I think about from a risk perspective, given the net zero push, is when you have companies that would be buying offsets or buying new technologies. In this climate tech 2.0, are they? What are we going to revisit from the errors of the past of the first generation of climate tech that will happen again and won't happen again? And some of the biggest challenges with climate tech in the original, generation wasn't that the technologies failed. It was that it was just very hard to get businesses to integrate their solutions. Integrating a heat recovery system into a smokestack required factory manager buy-in, and that's really hard to do. So we're also starting to see some innovative ideas out of the climate tech world of how do we move up and down the stack. If we're down the stack, it's like sucking CO2 out of there. If we're up the stack, can we start to change the way cement or concrete is made so that we're building our buildings with a better CO2 footprint? I think these are some of the things we'll start to see, as well as some additional plays in software to help companies track their CO2 consumption. Let's see, I think there's one more slide after this. And these are just something I think will have takeaway value for you all. Just, these are some of the very active investors in the space that you can find I think they're going to be very receptive to university tech transfer offices marketing your startups and technologies to them. I think in general, they always probably be more interested in meeting with startups, but I think you'd be surprised at some of the funds here's willingness to meet with researchers. I think that's just what's going on in the space, and everyone wants to access the next climate tech startup before their valuation has gone through the roof. I think that's it for this section. I can see if there's any specific clean tech questions.
There are some specific clean tech questions, and then we have a lot of more general questions. So Manny, regarding clean tech, what kinds of investment activity are you observing in the plastics recycling area?
It's interesting. There was a corporate that reached out to us about just the circular economy. And I think the general view that I have is like some companies are going after this. Can you make plastics that are more biodegradable, or carbon fiber, for instance, that's the resins can be degraded and reused, so the fibers can be reused. There's some of it, but that world has actually it's kind of, that was like a repeat of some of the things that happened in 2010, like the first climate tech boom. And where like the ideas are sometimes around, can you use CO2 to make cleaner plastics, or can you recycle plastics and turn it into something else? A lot of the challenges there, I think, will be repeated, which is, do customers want to buy lower quality material? Or what are the chances that as a startup you can meet the quality thresholds that they have for their input material? So I think those are some of the challenges we see. I think things like solar and plastics, will not necessarily be where climate tech puts its capital today. It's going to be in brand new ideas.
All right, next question on clean tech. Are you seeing equity investments from foundations that are focused on clean tech?
I wrote the punt. I don't know if I know the answer to that, Dina.
Okay, maybe actually Nabil can look at that in the meantime too.
Yeah.
So, okay.
The majority of the big investments are definitely coming from very large funds, but then there also have been very large family offices that get really active in the space. I just don't know if I think of them as foundations.
Okay. All right, great. Next question on clean tech. Comparing clean tech capital growth versus deal count growth implies almost all growth is coming from larger round size, appears. Any thoughts on that? Or do you?
I think we always have this issue of and when you look at this data and see the growth, that it's driven by the anomalies. And for instance, Commonwealth Fusion raising $1.5 billion round is definitely the largest contributor. So I do think it is driven by some of these very large rounds, but just the deal pace overall is, the number of deals has been increasing. But we can actually look at that. We can look at the number of seed investments that are happening and look at the growth in that space, and we're happy to do it.
Okay, great. If you could write that down. All right, now I have more general questions. So one of them is, do you guys have a sense of the M&A trends for each sector? I mean, obviously we've kind of generally talked about tech versus life sciences today, but within those as well, we've talked about IPOs and other things, but not particularly about M&A. Mitra, would you like to go first regarding what you're seeing as far as M&A?
Yeah, happy to, but I can only comment on biopharma, unfortunately. But so the private M&A activity has been down in 2021, and I believe it's the lowest that we've seen since early 2010s, right? And it's directly related to the open IPO window over the last 5 years, as most early stage companies have foregone M&A in order to and really embraced, the mezzanine rounds and then IPOs with really good valuations rather than early stage exits. So we'll see if that continues. It's been relatively tepid in the last few years. However, there are examples of big acquisitions in this space, such as Translate Bio was acquired for $3.2 billion, Pandion $1.9 billion, Constellation $1.7. So there's some good benchmarks out there, and hopefully, as IPOs slow down, there'll be other ways for companies to access that capital.
I think as the public markets do go through what we're seeing right now across the board as valuations, market caps decrease, you start to see more activity. There's an interesting plot I saw, just historical downturns in public markets, and biopharma acquisition usually grows as public market valuations go down. Similarly, on the tech side, private companies are basing a lot of their value on enterprise multiples. And so when those get depressed based on the public markets, you do see some increase in appetite or ability to buy. And we may see some of that. The other thing I think will be really interesting is if we do go through any, general depression of venture investment, which I don't think we will given the amount of capital that's on the market, but we may see a consolidation into dollars going into the best companies. Then it gets harder to raise capital, and then we'll start to see some. So I think we'll see an increase in appetite for acquisitions. It hasn't felt like it's been anomalously up or down for tech right now.
Mm-hmm. I have a couple of follow-up things on clean tech, just really quickly to try to round that out. So actually, Nabil was looking at PitchBook as far as foundations. but basically about investors in clean tech. Of the 320 reported investors in University Clean Tech in 2021, only 2 were foundations. So yeah, very, very small. I don't know what they were in particular. And then we have another question on clean tech that came in. Do you think the federal government's emphasis on clean tech is having an impact on innovation investment in 2021 versus previous years?
I think for instance, we've seen several startups take advantage of the kind of dearth of government activity in certain spaces. So there is this onslaught of fusion companies because they haven't been able to get the public funding from public government sources, and they're seeing the private appetite there. And so 2021, I think, was about researchers and startups seeing the opportunity to treat private venture investors as funders, and that's actually generally pushed more acceptance of funding research projects with big dollars. So normally, where some of these startups have been, very much science projects, would normally think of raising $4 or $5 million, they've been able to go raise $20 to $50 million. I think the two things that are happening, ARPA-E has proposed a very ambitious plan to fund and help the commercialization of technologies relevant to climate tech. I think that could be a significant program, but I don't think venture investors generally are paying too much attention to whether they can sort of get subsidies from the government. It's kind of a nice to have. We do like to rely on our own ability to fund the company over time.
Yeah, I think the question was more, this was my interpretation, was more towards like with the government funding more at the universities, and there perhaps being more innovations through that funding.
Yeah.
But yeah, that's okay. Well, and then I'm going to move on to a biotech question, and I'm not sure actually, Mitra, if this is one that you can answer, but we're going to kind of look into it. Nabil's kind of looking at it right now. And I think it's an interesting question for biotechs. Is there data to show how early stage preclinical IPO compares to a later stage IPO regarding success metrics, especially in the metric of getting products to clinic and FDA approval? So when they IPO, whether that's kind of early in their clinical stage or later in their clinical stage, how that affects perhaps the success metrics of getting a product to market.
That is a fantastic question, because honestly, the best metric is not how much money raised or how much you exit for, but like, really, is this product getting to clinic and to the people who need it? However, I think it's been a more recent phenomenon for these early stage companies to IPO. So I think the jury is still out. Mm-hmm. I had referenced earlier data showing that in 2013, the average age of a company was 10 years before they were IPOing. So they're much more mature. So we have, and we're assuming, given they're more mature, we have more data on whether or not their clinical programs succeeded or failed. So I think, that's something we'll have to track closely over the next few years to see if probability of success is impacted by the stage at which a company goes public.
I agree. Yeah, that's a really good point. Thanks, Mitra. So next question. When you're talking about the average deal size and the calculation of that deal size, what actually goes into that number? Is it investment of the company, upfront license fees? I imagine this kind of depends on how the investment occurs, et cetera. What are the numbers that go into that?
Generally, if I remember from most of the slides here, because I don't think we were talking or referring about M&A activity. So we're generally talking about venture round size. So how much did they raise? Right. And so we're doing that either by doing a gross thing of like saying, hey, how much capital was raised in the entire market divided by the number of deals. We also have the ability to just sort of create averages and medians of every single round that happened. And obviously the math works differently depending on how you do it.
Great.
So it's about venture dollars.
Okay. Next question we have is, are there PE firms that are particularly active in funding the growth of these companies that originated from universities? And Manny, I'll go with you first with this one.
Tiger. I mean, it's been tremendous how active they've been and overall in the industry, and then it's been consistently active in the university space. And you also have some of the related funds two tigers. So Tiger Co2 Edition is also an interesting one that's been active in the university space. I'd say they're generally looking at the Series A or later. I mean, Series B, C historically, but Series A is sometimes about as early as I think they would interact with the university space. Mm-hmm. There's a number of others on the tech side, but I'll pause there. I don't know if there's activity in the life science side too.
Yeah, so I would reference what you said earlier about, investors going upstream to get those better valuations. So you're seeing hedge funds now that have, their own venture funds like Avaro. You're seeing OrbiMed, Perceptive, they're all going earlier and earlier and, at the level of meeting with professors at universities and starting companies. So we're seeing that as well.
Great. Thank you both. And actually, Jackson Streeter just wrote in about SPAC deals, which actually gets to two other questions we had on SPACs, which I'm going to defer over to Manny here, which is basically one of the questions we had before was, have SPACs come and gone? Or the other question was, are SPACs here to stay? And are they strictly an alternative to the IPO? So Manny, comments on SPACs.
Yeah, I think we, in general, can say that SPACs are gone. I mean, there still is a tremendous amount of capital on the market in public SPACs that exist, but for it being a vehicle that some of the most exciting companies will use to go public is uncertain now. And so I don't see many of the companies I think are interested in doing SPACs anymore. Some of the ones that were interesting that announced SPACs but didn't close are surprisingly not closing. And there's a couple reasons for this. One is, the whole reason SPACs became what they did in the past couple of years, in general, was because they started to be more active in doing these pipes. The pipes would create several $100 million of additional capital in addition to the dollars in trust raised by the IPO. The pipes didn't really exist of this magnitude before, so you had this vehicle by which a startup could raise $600 million at very high valuations, and then they'd have runway for several years. What's happening in the past couple of months as these SPACs have not performed is they still do the pipes. They're a little bit less impressive, but they still happen. But they're starting to get these massive redemptions in the public entity when the deal happens. And so now they've sometimes lost the entire cash and trust, and they don't have $600 million. They've got $100 million. And so the whole incentive for the ecosystem has changed and almost deferred back to what SPACs used to be, which is a place for companies that aren't doing that well to get public. And it's something I think will probably continue to stay a third rail for a few years. But don't hold me to that.
Yeah, and I would say for biopharma, SPACs really took the sector by storm over the last 18 months. There were 36 SPAC IPOs raising money to go and acquire private biotech companies with really the promise of a few things. It was like faster timelines, less dilution, less pricing risk. And, there were some SPACs that outperformed, but most were underperforming. So I think, it's yet to be seen whether SPACs will be an instrument in the capital market toolkit in 2022, or if this is just a flash in the pan.
Great. Thank you both. Let's talk a little briefly about trends in financing types, especially early financing types, as far as convertible debts and notes, convertible equity. Are you seeing anything in those spaces that is different, or is it kind of consistent? Manny, I'll start out with you there, and then Mitra.
I think the biggest change. So I think it continues to be a seller's market. So startups do continue to have like in 2020 and in 2021, they continue to have leverage to get the terms they want. And oftentimes that is meant that convertible notes and safes are the first mode of investment in seed stage companies. And nothing has changed dramatically in how safes are done or how convertible notes are done. Kind of it's like a longer conversation about the differences. I guess the one thing that's changed in safe notes is there's been a YC move to a post-money safe, which is just a little more transparent for everyone involved. And we do like that better when we do it. But other than that, I don't see any big changes in how deals are being done. They're just done faster.
I would say that since we're seeing some of those typical like later stage investors move more upstream, the vehicle that they're using isn't usually debt. It's they'll price around earlier than they would have ever before. So you're seeing like price seed rounds where before you'd be using a safer convertible note. So that's really, I think, the biggest trend that I've seen.
Great, thank you both. This is probably a quick answer question for both of you. Which factor has the highest correlation to getting the first $5 million in seed funds, the faculty reputation or the startup management? Mitra?
That's a great question and a difficult one, right? There's a confluence of factors that goes into, how we decide to make investments. I think it's both, honestly. It would be lovely to have both of those things. I will say it's easier a lot of times for that company to get initial sort of conversations going if they have a well-known entrepreneur that's part of their team or a well-known scientific founder. But really to close those deals, you've got to, have a number of things in place.
On the tech side, I could say I lean toward, I think my instinct is a team. Most of the general tech venture industry is not as aware of scientific founders in the academic ecosystem. So they really base it on the team. $5 million is still a decent chunk of capital. So they really focus on team because the entire world is built around venture investors investing behind people.
Great. And just on the PE question again, following up, our analyst did some research in the meantime, and according to PitchBook, some of the most active PE investors in the spin-out space are Orbi, just as Mitra noted, Fidelity, Coatu, is that how you say that one? Sorry, could you say it again? Coatu, thank you. Silver Lake, Energy Impact Partners, and Blackstone. There are obviously quite a number of others of those, but just to give people some names to those. All right, I have one question left, unless we hear some more from our audience, and we can actually end a little early today, but we've loved all these questions people have sent in. And this is kind of a very broad question. I'm not sure it has a specific answer because it's so broad, but maybe you guys can delve into it. What stage of development do ventures need to be at to attract funding these days? And how do they get there to, get over those kind of hurdles that they go through in that valley death to get to the point that they're actually attracting that investor funding? So stage of development is really the question. And I know this is very, really going to be specific to certain areas. So maybe you can just call out some of those.
There used to be a hard and fast rule around this, 5 years ago, but now it's just, again, everyone moving more upstream where, a good idea is investable now, right? So I don't think there's really a rule right now. I think it's just making sure you have those relationships with the venture and the angel community, working closely with the tech transfer office so they can also be an advocate for you and help steer you towards the right conversations to have early. And, I think, it all hedges on just good science to start with.
I don't have that much different to say. I think it applies across both. I mean, good science is almost table stakes for a lot of the startups we see. And I wish sometimes the researchers would put as much effort into developing their team and networking to find as great of a co-founder as they've found in what they've created in their research. So I think that's the most important thing you can do.
Great. Thank you both. Well, seeing that we have no more questions, we are reaching the end of our webinar. And before we run out of time, we would love to collect everyone's feedback on our webinar. And I think when you quit out, you'll be receiving a survey, but there's also, we just put in the chat box the survey. So please do fill this out. We base our webinars based on your responses on these, and we hope to improve our webinars based on your responses to this survey. It's really short, it's 5 questions. So please answer this. So, and I would like to thank all of you for attending this. I know these webinars end up being long. We actually get a lot of feedback that people would often like them to be longer. So we try to accommodate that, but I'd also like to thank Mitra and Manny for your insights today, and to Nabil Ula, our analyst at OUP, for all his work on the data in this presentation and preparing many of the slides. as well as honestly all the other resources that we used, SVB, PitchBook, NBC, and others for the data and analysis that they provide. I'd also like to thank Katie Mangles in the background for running our slides today and everything else to do with putting this webinar on. If anyone who is still here has any additional questions, our email addresses are noted on this last slide, so please do feel free to reach out to us, and we're happy to follow up with you. So in the meantime, thank you everyone for joining us, and enjoy the rest of your day.